Hello, accounting students. We are here today to give you a brief overview of the accounting equation. Alright, the accounting equation is very simple and there's no need to fret about the accounting equation. Alright, put simply, the accounting equation is as follows. Okay, there it is. That's the accounting equation. We have assets, which are the stuff, the items, such as equipment, vehicles, cash, patents, inventory, accounts receivable, investments. Okay, so that's the basics. Alright, we have equipment, cash, patents, inventory, AR, and investment items. That's assets. So who owns the stuff? Alright, who owns it? Well, the people who own it are the people who have claims on it. Alright, we have liabilities right here. And this is banks for notes payable. We have creditors. We have accrued liabilities. Basically, anybody that has a claim on this stuff has liability. And then we have equity. Alright, we have the owners. So we have assets equals liabilities plus equity. The accounting equation always has to balance. Okay, so that brings us to journal entries. Alright, we're going to erase this right here. I'm going to redo this. Okay. Okay, now assets we can describe by Tcount. Alright, this is called a Tcount. And we have a Tcount for liabilities and a Tcount for equity. Okay? Now, the Tcount is just a graphical representation of assets, liabilities, and equity. Alright? Let's say we bought a car. Okay? Let's say we bought a car and it was worth $10,000. Okay? So, we bought a car. So the journal entry is a debit $10,000 for the assets. So debits make assets go up, right? So we debit the car for $10,000. Debits make assets go up. Now, how did we do it? Did we buy it on credit? Did we use cash? So we have to credit something. So let's say that we finance the whole $10,000 through the bank. Okay, that means we have a bank note for $10,000 right here. So we have the car, debit the car, credit the bank note for $10,000. The assets equal the liabilities. We have debit and credit. We credited the liability and debited the asset. Simple as that. Okay? Now let's say the owner puts in $20,000 of cash. Okay? So we're going to do cash, $20,000. Okay, right here. And then we're going to put equity So we have a debit right here for 20. We got to credit something, right? So we're going to credit equity for $20,000 right here. That's all there is to it. We have this car. We have this cash. All right. So right now we have $30,000 here in assets. We have $10,000 liabilities and $20,000 equity. So we have $30,000 equals $10,000 plus $20,000, right? $30,000 plus $10,000 plus $20,000. It balances. That's all there is to it. Okay. Now let's say we're going to sell this car. All right. We're going to sell it. So we credit $10,000 here. Okay. So that goes to zero, right? And let's say we pay off the bank note. Okay, so we debit the bank note right there. So we got rid of the car with a credit, and then we got rid of the liability with a debit. Okay, it's as simple as that. It's got a balance. The debits have to equal the credits. And this accounting equation always has to balance. So for journal entries, that's why on a journal entry you always have a debit and you always have credits, and the debits are balanced to the credits, okay? And that's how it works, okay? That is it. And it's as simple as that. There's nothing to it, okay? Now, I want to give you a brief primer. Something simple. All right. We have assets, debit, credit, liabilities, equity, debit, credit, debit, credit. Okay. Now, debits increase assets right here. Credits decrease assets. Okay? Liabilities decrease with debits and increase with credits. Okay? And then equity decreases with debits and increases with credits. That's it. That's all there is to it. All you have to do is memorize that. And it's got a balance. So when you have a debit over here that increases an asset, you either have a credit here or a credit in equity. It's got a balance. There's no other way to it. Okay? Now, a part of equity, right here, we have income from the income statement. And we have owner transactions. That's part of equity. So our income statement flows into equity. Okay? So net income, let's do this. So we got that. Right? So we have net income equals revenue minus expense. Okay? Net income goes into equity on the balance sheet. All right? So, net income equals revenue minus expense. Okay, revenue debit, credit. All right. Debits are always on the left, okay? Debits are always on the left. So, revenue is decreased with debit. Revenue is decreased with debits and increased with credits. expenses are increased with debits and decreased with credits. Okay? Simple as that. Revenue decreases with debits, increases with credits. Expenses increase with debits, and decreases with credits. And what you want is net income, right? So you want the revenue to be higher than the expenses. All right? That's all you have. Okay? Simple as that. And then we have our equity equals income plus owner investment minus owner distributions. Okay? So equity equals net income, which is hopefully going to be a credit, right? Plus owner investments, which should be a credit, minus distributions to owners, which would be a debit. And that's equity, all right? And then remember our accounting equation, assets equals liabilities plus equity. Right there. That's it. Equity is net income plus owners' investments minus distribution to owners. Equity flows into the accounting equation, assets equals liabilities plus equity. So equity has components such as net income off the income statement, owners' investments, owner distributions, and then we have assets and liabilities, and all this right here is on the balance sheet. Right? And this is on the income statement. Okay? Right? And this is on the statement of changes in equity. Okay. That's all there is to it. Now that is a brief overview of debits and credits and how the financial statements work. And I will be putting notes on our classroom so you'll understand debits and credits. Very easy. Very, very easy. Thank you for taking this course.